Today, we're going to review your real estate contract, but from a lender perspective. We're not trying to pretend that we are real estate agents here or attorneys. We're not giving you legal advice. We are saying when you do, in fact, complete your contract with your real estate agent and with your attorney reviews it after you complete the real estate contract and after you go back and forth with the seller. There's some really important stuff you need to understand on the contract from both a legal perspective, a financing perspective, and just a purchase perspective, the dollars and cents of it. So obviously, we're not going to discuss any of the legal parts of this, but we are going to discuss the financing parts of the real estate purchase agreement and what you need to understand as a buyer. Let's just start with the basics. When you, in fact, make an offer, your real estate agent, the buyer's agent, usually is the one that completes the contract. By the way, this is the multi-board residential real estate contract 8.0. This is the most current contract available for the Chicago area and the suburbs. Most realtors that I see are using this contract both in the city and in the suburbs, but they do have the option to use a different contract in Chicago. But usually the real estate agent is going to complete this with you when you are ready to make an offer. And obviously the basics, they're going to put in your names, they're going to put in the seller names, they're going to put in the real estate. What are you looking to buy? If in fact it's a condo, is there a deeded parking spot along with it? And now we get into the nuts and bolts of it. What is the purchase price that you are offering? So we just did a video on a condominium unit that was $390,000. Say that was listed at $395. Depending upon how hot the market is, you might come in at $385 or you might come in at $380. And then of course the seller is going to counter on that. There is also the ability for the seller to give you a credit. Now in this example right here, the credit at closing is in this section. In a softer market, sellers are willing to pay credits to kind of sell their home, to help market their home. This current market is pretty competitive, and it's unlikely sellers are going to give large credits. But this is something you definitely need to discuss with your real estate agent as to how hot the market is, and can you ask for a seller credit in this situation? Earnest money. How much earnest money are you going to pay? Now, a lot of buyers who are just getting started don't even know what earnest money is. Earnest money is basically a deposit that you're paying to the seller to be held in escrow that then becomes part of your down payment. The larger the amount of earnest money you put down, the more serious of a buyer you are viewed in the eyes of the seller. So if somebody's just coming in and offering $3,000 or $5,000, they're not going to be viewed as favorably as somebody that's putting down $10,000 in earnest money. And remember, your earnest money becomes part of your down payment. So this section right here will tell the seller how much you are willing to pay in earnest money as a deposit on this property. Of course, the balance is due at closing. In this situation here, or in this section, I should say, of the contract, this talks about, is the seller willing to compensate the buyer's real estate broker their commission? You probably heard about the NAR lawsuit, the National Association of Realtors lawsuit that was all the news last year. Almost every contract that we are seeing these days, the seller is paying the buyer's agent their commission. But obviously you need to pay attention to this section here for that. When is the closing? The sooner the closing, the better in the eyes of the seller, typically, unless they are delaying their move for some reason. What we see a lot these days is roughly 30 days for a closing, and that's going to go in this section right here. Fixtures and personal property that are part of the contract at no additional value. All of this stuff is kind of considered what we define as real estate. That is stuff that is attached to your home and therefore can be financed as part of your purchase price. Freezer, oven, dishwasher, trash compactor, microwave, obviously sump pumps, ceiling fans, etc. That's all considered real estate, which can be financed as part of the contract. The section that gets a lot of people tripped up is right here, where a seller might include other items as part of their home to you as the buyer. However, some of that stuff simply cannot be financed, and underwriters will require it to be removed from the contract prior to proceeding. So an example is, a really fancy furniture set that they're leaving that, might cost $8,000 or $10,000 or more if you were to buy it new. And that looks like an inducement or a seller concession in order to get you to purchase. Many times that's going to have to be removed from the contract. We've seen some extreme examples where a seller has left a car, where a builder, left a BMW in the garage, and there was a side agreement that said, hey, if you buy this home, you also get this new car. That's extreme. That almost never happens, but that is an example. Obviously, if you're buying a $300,000 home and you're getting a $50,000 car along with it, what are you really paying for the home? So lenders obviously want to prevent against home prices being overinflated, and that's why they check that section of the contract. Financing contingency, this is where we come in. So, as a home buyer, the overwhelming majority of people out there don't have enough cash to just buy the home outright. So the contract protects you, again, not legal advice, check with your attorney, but usually the contract protects you that if for some reason you can't get approved for your loan, as long as you notify the seller within the allowable time frame that's listed here in this contract, you will be able to get out of the contract without losing any of that earnest money that we talked about previously. Again, legal question, discuss it with your attorney, but usually if you don't get approved for your mortgage, you can get out of your contract. And then here are some sections that, we're seeing a lot of these days. Some people are making cash offers. Obviously, those are the lucky ones, and they have a ton of money. And it says right here, cash transaction with no financing. So if that's you and you're making an offer, they're basically telling you can't go out and get a mortgage. You're making this offer to the seller with cash. You're saying, I have $300,000 to buy this home outright, and we're not going to get a mortgage. This other section here is what we're seeing more and more of. This is cash transaction financing allowed. So say somebody has a ton of money, but they want to take out a mortgage. They want to borrow $200 or $240 or $250 or $270 in the scenario we're talking about with roughly a $300,000 property. They can make an offer and say, if for some reason our mortgage financing does not go through, we will still pay cash for this property. Obviously, it's risky, but if you have really good credit, sufficient income, good job stability, and assets, you're going to get approved for your mortgage. Could the appraisal come in a little bit low? Yes. But typically, it's not like you're at risk for $300,000. Again, check with your attorney, talk to your real estate agent. But that's what this section means here. You're willing to tell the seller, hey, if we can't get approved, we're still going through with this and paying cash. But in fact, we plan on getting a loan. It's just a way to make your offer stand out more than some of the other offers you'll be competing with. Homeowners insurance. This is a really important section of the contract these days that just sort of was overlooked in years past. So just get your insurance, a little bit closer to closing. But with many insurers pulling back, and in many parts of the country, it being very difficult or at least very expensive to get insurance, this section is more and more important. So it basically tells you the contract is contingent upon you, the buyer, obtaining evidence of insurability within 10 business days after the date of acceptance. So when you make an offer and that offer is accepted, your primary calls are going to be to your lender, your home inspector, and your attorney. And right after that is to your insurance company to make sure that you can, in fact, get insurance for it. Flood insurance, the overwhelming majority of properties are not going to be in a flood zone, but it's really important to know it. Prorations. This is an important section. Your attorney is going to work this out with your real estate agent. But basically, when you're buying in a state where the taxes are paid in arrears, the seller is responsible for paying the last year's tax bill. So 2024 taxes have not been paid yet, or at least the second installment. And the first 3 months, we're doing this in April here of 2025. The first 3 months of this year are not yet due and payable yet. So prorations simply mean the seller is going to give you a credit for the amount of that tax bill that has not yet been billed. And usually that number is going to be like 105%. We've seen some at 110%. Okay. The attorney review, this is standard language. Your attorney has 5 business days to review this contract after the date of acceptance. So again, a lot of first-time buyers are very nervous when they make that offer and it's accepted. Your attorney can protect you for a whole variety of reasons to get you out of this contract if something goes wrong. Basically, it's supposed to be anything but price. But again, defer to your attorney on that one. Make sure that they have explained how you might be able to get out of the contract. But obviously, don't go into a contract if you really have cold feet. Another important section, are you buying this property as is? A lot of people are making offers to say as is right now, where they're buying the property as it stands. I don't necessarily recommend it. If you're buying a tear down, you're going to tear a house down and build on it, you might do that. But here's where you get into other inspections. So if you're buying it as is, you're probably going to waive your inspections outright. Here's the most standard one, right to inspection with requests. This is also something you want to talk to your real estate agent about. But this basically means you can inspect the property, your home inspector comes through, looks at it, and then you can make requests like, hey, this roof is 20 years old. We would like it replaced. Or this furnace is super old. Or sometimes it's just a cash contribution that you're looking for as opposed to actual repairs being done to the property. So kind of keep that in mind. And then this is something that we see a lot of buyers do, at least right now in this hot market. A right to inspection with no requests. It's in essence a pass-fail inspection. So, you're buying the property, a home inspector can come out and look at it, and if they're like, holy smokes, there's a lot wrong with this property, you technically cannot go back to the seller and say, hey, we want this, this, and this fixed. But you can say, we don't want this property anymore because there are these issues. Just keep that in mind. In the end, everything is kind of negotiable, but this is when you're trying to tell the seller, we love your house, we want your house. We still want to safeguard ourselves and be able to do an inspection, but we're not going to hit you up for a bunch of requests, either financially or repair-wise as it relates to that. Wood-destroying insects, termites, very prevalent in certain parts of the country, so you want to make sure you look at that. Condominiums, really important if you're buying in Chicago or in any of the other big metropolitan areas. Your condominium also needs to get approved. So is there litigation against it? Are they holding sufficient reserves for the repair of the condominium? Obviously, we had that tragic loss in Surfside, Florida, and Fannie Mae and Freddie Mac have really ramped up their efforts to say lenders need to look at the condominiums and see if there's deferred maintenance. We're not engineers, we're not inspectors, but we're looking for obvious things. So you really need to pay attention to condos. This is a section of the contract that addresses that. The rest of this is pretty boilerplate language that you're not going to look at much. Your attorney obviously will, and your real estate agent, but we're not going to go through that little area right there. And then as we get to sort of the end of the contract, this is simply where the contract is accepted. So, usually you're going to make an offer, the seller is going to counter, then you might counter and say, hey, this is our final and best price. Sometimes the seller counters and say this is their final and best price. And hopefully you meet in the middle. Once that happens, the contract is accepted in this section here, and you have an executed real estate contract. So hopefully you learned a little bit from that. The real estate contract in the greater Chicago area is, of course, a standard templated document, but there's a lot that goes into it. There's still a lot of room for interpretation. We strongly recommend you work with a great real estate attorney and, of course, an experienced realtor to not only get you the home that you want to be in, but to protect you as well going into it. So thank you very much. Thank you for spending some time with us.